Our next speaker, Naik. He is the CEO of TransUnion Africa. There he's standing. So Lee is recognized as one of South Africa's leading digital and technology transformation experts. You can go Google him on YouTube. You will see so much content. This man knows his stuff. And he is on a mission helping consumers make informed decisions and businesses to uncover economic opportunities. So Lee's talk will be promoting financial inclusion through secure and customer-centric data practices. Let's give Lee a warm welcome.
Good morning, everyone, and thank you for the opportunity. Just talking about the world we live in, this jacket just entered the door as I was waiting in the back because I'd forgotten it at home. But in the world that we now live in, I could call an Uber package to go to my home, get the jacket from the dining room table, and get here just in time as Amy catches her breath. So thank you, Amy. So I want to talk about, it's a round of applause. Yeah, go for it, give it. Right? But I guess the point about the round of applause talks about the world that we live in. And complementary to the previous speaker, right, there's a lot happening around the world. And this is a fintech summit. And for many of you today, you're going to spend time looking at the wonderful innovation next door. You're going to talk about cool stuff like payment rails. The real question is, what is the opportunity? What are we really here for? And if we figure out why we're here, then all the cool gizmos and gadgets and payments and digital stuff we do becomes a lot more real. The real opportunity is how we drive inclusion. And so you've heard the numbers. The numbers are not just the fact that Africa has 1.4 billion people. The reality, though, is that in the 1.4 billion people, 500 million people are excluded from participating in that economy. Now that's the real number. So what does it practically mean for us? Financial inclusion, using a World Bank definition, is giving access to financial products or services to every single person. Across the entire 8 billion people in the world, there are 2 billion people that match that definition. Over the last 3 weeks, I've had the chance to spend time in different countries. I just got back from Brazil, where the World Bank had their ICCR conference, and I had the chance to showcase about 6 years of work we've been doing to solve this problem called financial inclusion. I haven't solved it, that's the headline, right? But I'll share with you what we need to start to do as fintechs and as an industry to start thinking about the problem. Building a new app, building a new way to take my money away from me when I don't have money, that is not what inclusion is. Right? So my presentation, one of the privileges of being one of the oldest bureaus in the world, we started in 1901, we do have a lot of data. So my job is to help you understand how we do financial inclusion right. Inclusion is not just give me a place to store my money. I can store my money in a Gautrain card and never use it. We call that lazy money. I can keep my money under my bed like my dad does. It doesn't grow any interest. Or I can find a way to grow my personal wealth. Now, why is that important? What's different about the African continent is that in Africa, it isn't large businesses like TransUnion that create employment. 80% of employment on the African continent comes from small, medium, and micro businesses. Every small, medium, and micro business creates between 1 and 5 jobs. So 80% of all employment comes across the continent. When we talk about the 32.1% reported unemployment, the solution is not for TransUnion or ABSA or Telkom or MTN to hire more. We'll hire maybe 50 people this year. It doesn't make a dent when you've got 32.1% unemployment. Now, part of coming up front in a 2-day conference, I like to put everybody into what we call the valley of despair. I want us to feel forlorn and figure out why we are where we are. And if we get that right, then we know we're solving a problem that's meaningful. So let's use South Africa's data, which you haven't heard yet today. South Africa has 32.1% unemployment. What you don't know or may not know is that we have 29 million people out of 40 million adults that collect social welfare. 29 million out of 40 million. Prior to the pandemic, we had 18 million. These are people that child disability, widowers, a whole bunch of issues that defined by SASSA at the time. What's different is that post-pandemic, we now have 11 million people that have social relief distress grants. You've heard about this, 350 rands a month. Now, when you talk about 350 rand, it sounds like a big enough number, except that the World Bank defines the national poverty line in South Africa as 750 rands. So the minimum amount of money you need to have nutrition in your body to live a good life is around 750 rands. The 350 gets you halfway there. So you have just enough money to be hungry and not to fulfill your life. Are you guys getting it? Inclusion doesn't mean giving me just enough to want and crave more. It gives me the opportunity to actually move along the journey from having a store of money, which is what the World Bank talks about, into a point where I can transact and engage and start to get leverage. When I start to leverage money, I can start to build my first house. I can start to want to propose to my girlfriend. I can start a small shop in the corner of the street. I can start to do things when I have access to leverage. If I'm 50% short before I started, I'm never going to get past the front door. Does everybody get that? Now, if we understand in this valley of despair that that's the problem, then it changes how we think about why we are fintechs and where it needs to go to. So, a couple of things worth noting. Everyone seems to know this, but fintechs are on the rise. So what does it mean practically for Africa? Between now and the year 2030, Africa will have the highest growth of fintechs of any region. The top 3 regions are Africa. We're growing at 13 times. LATAM growing at 12.5 times, and APAC growing at 6.5 times. Now that sounds logical, because these are where the highest populations are. Africa will be a $65 billion business just a few years from now when it comes to our fintech industry. So you're here in the right conference at the right time. You can access up to $65 billion of fintech spend in the ecosystem. So you're in the exact right place. The question is, what do you do to actively participate in the economy? So fintechs are on the rise, but why is it on the rise? So when I was in Rwanda 3 weeks ago, I was invited by the Central Bank of Rwanda to talk about how we can drive women empowerment. Now it's interesting, why women empowerment? Because Rwanda, unlike South Africa, has 99% financial inclusion. 99%. How do we know this? We run the only bureau in Rwanda. They have 7.7 million adults in Rwanda today. 3.6 million are on the bureau. So we are about 50% there. However, a few years ago, MTN launched something called Momo, which is their mobile wallet technology, which is also in South Africa. In the mobile wallet, in 2 years, they now have 5.6 million people using the wallet. If you combine the mobile wallet and you combine normal transactions from a traditional finance perspective, we have over 100% cover, right? Now the question is, okay, now everyone's participating. We're starting to store our money somewhere. The rise of fintech is not just about storing my money, it's what do I do with it? So the question to us, as from the government's perspective, Paul Kagame says, we know that Rwanda isn't doing as well with women empowerment. How can we now intentionally find ways to identify these women that show potential and give them access to finance? Liquidity is not a problem, right? Africa is one of the highest growths of VC and private equity funding of any geographic region. That's not the problem. The problem with inclusion is that when I walked up on the stage today, I had a suit jacket on. If I didn't have the jacket on, you would have judged me differently. Does he have no respect? So I do have respect, I put the jacket on. But one of the things we do in financing, you may not know this, when you walk into a bank to ask for money, we do something called point-in-time decisioning. So based on the color of that suit, based on how you look, how you showed up, did you shave, we make a decision to lend you money or not lend you money. Because you're either good or bad at a point in time. Do you get that, right? That is historically how the system of disenfranchisement has worked. How I look, how I show up, the car I drive. You can make choices about me. If I told you I was a BMW driver, it's like, oh my God, Lee, how can we allow you to be the keynote, right? If I was an Audi driver, you sound safer, right? Do you guys get that? That's historically how we are. The point about fintech on the rise is that the techniques we use has evolved. Last year at this conference, we spoke about AI, we spoke about social data. A lot of this is now not just becoming advanced, it's becoming mainstream. Last year, for the first time in South Africa, we were able to find a way to see 62,000 SMMEs for the first time that could not be seen before. Now, what does it mean? It means that a fintech went to a bank and said, I have an amazing idea, right? And the bank said, listen, I love your idea. Now give me 19,000 pages of documents so I can consider your application. By the time that process is done, the cash flow is gone, the person has had to take up normal employment, and the idea is dead. Do you get that, right? For those people last year, for the first time, we were able to track people that applied compared to the full year 2022. We found that 62,000 people that couldn't be seen by the system, by using new techniques in AI, in data, right? We're able to see not just what is wrong with Lee today, we could see Lee's dreams and see his hope. For example, a few years ago I was really bad. I recognized I was bad. I could see that in the information I have around, because information is power. I started to become better. And now the models that we use to make decisioning don't just see that I was bad. It says I was bad. I recognize that. I see you becoming better. And I can now model the fact that you'll be really good in 3.2 months. I can provision the risk from a risk perspective, but I can take a chance on you today. Do you guys get that? Everybody wants you to have hope in them. Everybody wants you to take a chance on them. The techniques we're employing, the things you're going to talk about over these 2 days, it is useless unless we can see the good people. Every conference topic will be around, how do you find the good people? We're going to change that to how do I see the hope in people? The hope is what we need when you're talking about 32.1% unemployment. When you're talking about a time when people are doing business like in the picture here. When you go to Rwanda, no one ever asks you what's your EFT details. Can I touch your phone? Can I send you a short code? Can I send you a postcode? That's what normal looks like. We are very westernized in South Africa. We need to change the way we think. So fintech is on the rise. It's going nowhere. But we've got to talk about this thing called the real financial inclusion. So financial inclusion is happening in South Africa. Let's not be despondent. Every month, we add around 105,000 people onto the bureau. We call these NTC, new to credit. Do you guys get that? So new to credit meaning you couldn't be seen by the system before, you now have been added. You open up your first account. It could be a personal loan, which is secured or unsecured. It could be a credit card. It's most likely going to be a retail card. The first step into getting credit is normally a retail card. You've gone to your Joshua Door or Edgar's or Ellerene's or one of these stores that hasn't closed down, because all the examples I gave you have in fact closed down. But you normally start there because it's least risky. I give you 100 Rand to buy clothing. If you pay your car on time, I give you 150 Rand. It's very different if I've given you a car and you can't pay the car back. So you build up your credit using retail. Now, here's the scary part about this. We track cohorts of people as they move through the financial inclusion journey. Of the 105,000 that enter financial inclusion every month, a third, right, default before they get to the end of the year, right? So you hear credit bureaus are defaulting you and blacklisting you. We talk about defaults when you miss a payment, right? If you miss 3 months in time, it starts to get serious, right? That's the way the rules work. We look at how many months you're missing. After 3 months, you're on a very slippery slope. And as you then start to miss even further, you're now in the territory of what you call a judgment or a listing. Okay? A third of people get into that position a year afterwards. Now, what does this mean? It means that when we saw the people and they joined the ecosystem, we may have found that they were good today, right? But actually, it's very tough being good today on a prolonged basis. Why? We haven't increased our interest rate since May 2023. Good news, right? You guys get that? We're hoping it turns around the corner soon. In fact, we study millennials all the time. Millennials are the most optimistic population in South Africa. 87% of them believe post-election that things will be better. I think we all hope and pray that that is in fact the case. So there's a lot of positivity around that. But let's just go back to the cohorts that are joining. One of the challenges is that I could join today, I could get access to finance, but it doesn't mean I'm a good repayer, right? I've got the money, I've spent it on Nando's, and now I can't pay it back, right? Something as simple as a meal could trigger you on the wrong pathway. So what we want to do is find a way to better understand these cohorts. So a third of the population actually starts to default within the year. So 2/3 are actually good. Now the question is, as you think about fintechs, you've been told before you got to the conference to find the good customers, but it's harder to find the good customers. Now, if you look at last year, the end of 2023, in Q4 specifically, the highest growth of financial products actually came from Generation Y and Generation Z. That young group, 18 to 24, the ones that are the most positive about our future, they had the highest growth of financial products. Why is this the case? They refuse to accept that South Africa is doomed. The highest growth in vehicle asset finance came from the millennials. So they want to do better, right? What we're starting to see, which is really promising, is that those cohorts, the youngest, realize that money is power. They realize that credit is powerful, but if not used responsibly, we're going to be in trouble. So they're starting to behave differently. We can actually track their behavior. Almost half of those people that are good, the good ones, a year later, they're starting to buy new products that move them up the inclusion journey. They're starting to access their cars, and we've seen that in the growth of the vehicle finance industry, specifically used cars, not new cars. People are now looking for better deals. In fact, most households, including myself, have not kept buying new cars at the pace we did prior to the pandemic. So a lot has changed. So when we talk about financial inclusion, the point I'm trying to make is that a business like ours, we see all the data. We can cut it different ways. We as fintechs, we have funding, we've got VC funding, we've sold our house, we're putting it into our business. To call the right business is extremely difficult. And if you all are targeting the same good customer, you're going to lose the customer within the year to something we call remarketing, right? My kids are young. You offer them bubble gum, they'll change service providers. Give them a free ice cream, they'll change, but in telcos. We have no more loyalty anymore. So when it comes to fintech, if we're going to be a $65 billion business in Africa, right? How do you start to find the customers and groom them? There's something that's quite powerful when it comes to customers. Before the pandemic, I was highly controllable as Naik. I've only ever bought the same car. The exact brand I bought my first car, I've never changed. I always change my car every 3 years, and I change it just before 80,000 kilometers because I assume things break at 81,000 kilometers. Post-pandemic, I haven't bought a car. I've extended my warranty and I'm staying with my car, and it appears to be fine. What has happened? Prior to the pandemic, you thought you could control me using your brainwaves and your advertising and your billboards. Now all I care about is the health, wellness. If I died today, was I working or was I with my family? That's what's changed. So as a fintech, you actually can't control me. I'm fickle, I'm agile, I'm irritable, I'm going to move. Why should I stay with you? One of the biggest things to take from my talk today is the word hope. In a world of using Neelan's data points as well as with all the negativity going around, who will lean out and say, I see you not just for what you are today, but who you dream you're going to be, and I can see how you can get there. That's what real financial inclusion is going to be about. So this is fraught with both opportunity and risk. Opportunity, $65 billion. Risk, you may not survive the year if you get it wrong. The biggest thing for me, and we work with 7,000 businesses in South Africa, I see every version of the same thing being shown to me as a net new innovation. The challenge for us as fintechs is we're not seeing that. We're going to have to copy what's working and then focus on what hasn't been done yet. if I hear one more person telling me that they've got a new origination algorithm, I've seen too many. Everyone's got it, right? What's different about yours? We need to also realize that the people that are getting it right are thinking differently. So let me give you, as a flyby, a few examples that I think are really interesting. MTN, I mentioned Momo. It is all over the place. Momo is the big play into fintech. It's all over the continent. That's one example, right? You got to find a new way to access the growth. So their play was, we're a telco, we've got millions and millions of consumers. Why shouldn't we become a bank? They're now a financial services provider. They started with something called airtime credit services, which is lending you money, right, on a prepaid contract before you have the money, and you can top it up later on. By learning behaviors, we can start to model propensity to give you more. So if I can trust you with 10 rands, I can trust you with 100 rand. We can start to grow. Now, in places like Rwanda, Zambia, and South Africa, Momo is now a mainstay paying. Very few people are going to use actual EFTs and even PayShap for that matter, right? We're going to find ways to exchange money in other novel ways, right? That's what's happening. MTN has also launched something called Chinosis, which is probably the first telco API marketplace. And what they're looking to do is say, listen, we need to be connecting everything. It's a version of what Safaricom calls their super app. Basically, you've got a widget that can do origination. I want the widget. I don't care to call it Bob's widget. Can I just use it and call it Lee's widget? Sure. And I'll pay you 2 cents whenever I use it. So super aggregators are showing up as marketplaces. And what this means is, it's kind of like using my famous bad example of KFC. I know I need 11 herbs and spices. I have 3 of the 11 herbs and spices. The other 8 come from a place called No One Cares, but it comes with a 99.9% SLA. I'm going to take it from here, take it from there, take it from there, and wrap the recipe together. To access the profit pools in the $65 billion, you have to stop doing it by yourself. You may become an enabler for other services. We call these the platform rails. Think Uber, right? Uber connected my suit jacket with a car and brought it here. That's the rails. You can think of how Discovery, right, which we don't always see as a fintech. They're the largest fintech we have, right? They took Vitality, right, which is our homegrown product for wellness. And if you go watch Liverpool or Arsenal or Everton, they think it's theirs. It's actually South Africans. We've repackaged modular value in new ways. So MTN is a really good example. Yo-Yo is a partnership with the We Group. If you're getting your free coffees from Vida for going to the gym or at least swiping the card to get the free thing, which is what I do, that's part of what Yo-Yo does. Whether you go to an engine garage or go to Virgin Active, they're starting to super aggregate. They realize that we needed to partner, right, to add value to the ecosystem. No one cares for you to solve their problem. They care that the problem needs to be solved. How doesn't matter. Go back to my KFC example. If I dare to go in to get KFC, I don't really care where the chicken came from. I have a need and that I'm really hungry, and I want to solve that right now. The last one, if you recognize the logo, is Time Bank. Time Bank had a really novel innovation. They went after the Zion Christian Church and said, listen, we're going to bank the Zion Christian Church. And you wonder, how do you make money? And the view was, actually, we don't know yet. We're going to find a way to get millions of ZCC members into the banked environment. But the idea wasn't to build hundreds and thousands of branches. It said, why not borrow somebody else's distribution? So they went to Pick n Pay, they went to Boxer, and now that's where Time Bank is. It's at the back of the store. Why do you define a bank as a physical bank with boring people in suits, right? Maybe the boring people are in the Pick n Pay handing out time cards. Maybe it's the cashier because no one cares. Are you starting to get this? How is the commodity? What is the proposition? In response to the why is the opportunity to make Africa a better place. Not only did Time do that, Time then went and said, okay, the problem is not the consumers. These consumers really want jobs. Everybody wants a job, but there aren't enough jobs because the people that create jobs in Africa, the SMMEs, aren't able to access funding to keep their businesses alive. That's the challenge. So what do? They went and bought a partner, and now they're able to give finance to thousands of SMMEs. Last year, over 32,000 SMME loans were granted. Why? So they can create the jobs that require people to apply. And when they start to apply, those end citizens become consumers on the demand side of the economy. When you think of our low GDP growth, it's not going to change if you pray. You can pray at church, but we need to be employed as well. If we structurally fix South Africa, electricity, water, logistics, and we start to empower small, medium, and micro businesses, then in fact, we will in fact grow the economy. So there are 3 things to wrap up this conversation on, and I want you to think about these 3 points. For each one of us, we're going to reflect on, for us to be successful fintechs in Africa, we're going to think about 3 things. The first is efficacy. Efficacy is not just doing things in the best way possible. Efficacy is doing the right things in the right way. In my view, and I've spent my whole life transforming businesses before being the CEO of TransUnion, we don't always spend time making the right choices. You may have to stop doing things like building stuff you know your competitor does better than you. Something you could buy from macro, you think that, I should build it from scratch because I think I'll do a better job. No one cares. Don't focus on the how, focus on the what, and focus on doing the what as effectively and efficiently as possible. So that's super important. If you aren't effective, you won't survive the year, right? In the microfinance space, in the COVID pandemic 2 years, over 1,000 micro lenders shut down because they couldn't see beyond the tip of their nose. If you aren't evolving how you work to be relevant today, you won't be relevant. That's the first thing. The second thing is to measure growth. So how are you counting what success looks like as a fintech? If you just count on the fact that you've got an app, there's over 1 billion apps out there. You've got the wrong measure, right? If you look at some of the data I gave you earlier, how many customers have I found? How have I moved them along the food chain? How loyal have they stayed to me? Right? How have I improved my basket size from giving a 5 Rand loan to a 10 Rand loan? How have I gotten them to be even stickier? Right? I believe that if I quit my telco, the telco will go down. It's not true because I changed my telco recently and they didn't even flinch. Right? The truth is that you want to feel like that as a fintech. Right? You are the future, but you're measuring the wrong things. So how do you measure that? And the final thing is governance. There's an infatuation with being a fintech. And the number of people that have shut down their fintech businesses over the last 5 years will blow your mind. We think having the right governance, the right processes, the way you choose your investments has to be more than, shiny objects. There's way too many shiny objects. At a technical level, every idea that you have in your head, 5 people have the same idea today. If they don't have it, they're going to listen to your idea today and tomorrow. They're going to copy it by next year's conference. I guarantee it. We call this mean time to commoditization. When we think of an innovation like the one I presented in Brazil, 5 years of work to be successful this year. 5 years. And we're a bigger organization with more capex to throw behind that. How would you get your governance right in terms of where you spend your investments and how you think about the future? So with that, that's a flyby. I do hope it's been interesting for you to understand that financial inclusion is Africa's biggest problem. It isn't just a theory. There are 17 sustainable development goals, 7 of which are enabled if we solve financial inclusion. So I wish you all a wonderful conference, and I hope that you've taken some of these inputs. And it's a provocation. We're in this valley of despair that says we are being asked by Africa to help Africa become a better place. It isn't the big players. It's not the TransUnion. It's not the bigger banks. We aren't agile and responsive enough. We can partner. You can partner. But if you don't do this together, Africa is the loser. And I like what the previous speaker said. If you did nothing, Africa's still going to grow. Africa today is growing at the highest population rate of any continental area. We're growing at 2.3%. Our population makes up 17% of the world's growth. By 2100, we'll be 40% of the world's population, having grown 2 billion people. With all these people growing, what are we going to do with them, right? We get to decide, and that's the power we have as fintechs. We are the future. Well, I'm calling myself part of you guys. We are the future. We get to decide what we do. So I wish you all a wonderful conference, and here's to fintechs. Thanks, everybody.